After talking with thousands of investors over the last 5 or 6 years, I've realised that majority of those investors want to find positive cash flow investment properties. So in today's video, myself and Crystal are going to break down exactly how you can find positive cash flow investment properties so that you can start making a little bit more money, generate the best return on your investment, and become financially free sooner. Now, I think the first thing to talk about when it comes to positive cash flow or just property investing in general is the fact that there's always going to be a bit of a trade-off, right? You know, you're always sacrificing one thing to get another. So when you are going for positive cash flow, more often than not, you are sacrificing something else, whether that be quality of location, maybe it's capital growth, maybe it's timing. There's a lot of different things that need to be sacrificed, but that's life. And unfortunately, we always have to make concessions. What we need to do is our cash flow analysis. We need to make sure we're doing our risk management to justify what things we are willing to sacrifice. But to kick off today's video, Crystal, let's talk about the first way that we feel as though is the best to generate positive cash flow.
When it comes to property investing, timing is one of the most important things. So trying to time your purchase as close to the bottom of the cycle as possible. And I know this is really hard to do. No one ever really knows the true bottom. And often once you've seen the bottom, that sentiment's really low. No one's willing to jump in that it's already started to climb before people are willing to get into the market. One of the things I've done, or I did with my own investment journey, was I purchased my first ever property around 2016. This seemed to be quite a true bottom for Brisbane when we look back at the last 5-6 years of growth. At that time, it's important to note that the property wasn't positive cash flow. So for the first sort of 18 months to 2 years, the property was either neutral or even slightly negative after costs. But purchasing the property at such a low price and my debt position being very, very low, with rents having increased over that 5-6 year period, now rents for what would have been, say, a $380,000 purchase, it was rented for $350 per week. All of a sudden, the average 3-bedroom home in that area is rented for between $410 and $500 per week, depending on the condition of the home. My debt position has only gone down in that time. So I'm able to now hold on to a property in a really high growth suburb of Brisbane that is now positive cash flow. It did take time to get to that point, but jumping in at the bottom when no one else was really ready to or interested in buying gave me the opportunity to get a property at a really affordable price that now has gone up quite a lot in the rental value, and therefore that timing has really helped me generate some positive cash flow.
I love that so much because the strategy was to generate both capital growth, short, medium, long term, and also generate positive cash flow as soon as possible. And it's not commonly talked about when talking about positive cash flow, the idea of timing, securing a property with really low debt levels and letting the market just naturally drive it up in value. One of the other ways that we love to get positive cash flow is by manufacturing it yourself. This is by, adding some value to the property in one way, shape or form. Now, we've talked about the house and granny flat strategy a lot. This can be a very, very powerful strategy to generate positive cash flow. So where you buy a house at, say, $550,000 that rents out for about $450 to $500 per week, that's available right now in the Brisbane market. You then build a granny flat in the backyard, and after the crazy increases in the construction industry, they cost about $200,000 right now. But with the increases in the rental market, they rent out for about $350 to $400 per week at the moment. So you can be into a property for a total project cost of $750,000 to $800,000, but you'll be able to generate over a $800 per week, maybe $850 per week worth of rental return. So you're getting to that 5.5%, maybe 6% rental yield. So that can be a really, really solid way to generate positive cash flow. It's a super low risk strategy as well because you've got multiple incomes on the one investment property. It enables you to use long-term capital growth within the strategy as well as manufacturing short-term cash flow. So this is something that we help a number of clients do. Another one that's pretty unique and definitely not for the faint-hearted because it does require a lot of activity. It does require a bit more risk. And this is the knockdown rebuild strategy. So similar to the house and granny flat, But what we'd look at buying is just a really dilapidated house on a nice big piece of land in a really good high quality suburb in a quiet family friendly street. You bulldoze the house and then rebuild a brand new dual income home. Maybe you've got a 3 or 4 bedroom, 2 bathroom side that rents really well, about $550 plus per week. Then you've got your 2 bed, 1 bath granny flat as well that's completely separate and rented to a separate household. You know, you'd be getting another $350 plus per week from that side as well. I'm personally looking at implementing one of these strategies. The house and granny flat, I've got a 3 bedroom, 1 bathroom house on a nice big 700 square metre block of land down in South Brisbane in the Logan City Council. My intention in the future is to actually leverage off the equity in the property and build a granny flat, a 2 bedroom, 1 bathroom granny flat in the backyard that I'll rent out completely separately, and that'll give me about $10,000 to $15,000 positive cash flow from the day that I rent the granny flat out. So really, really, really solid returns there. So they're our 2 favorite ways to generate positive cash flow whilst also targeting long-term capital growth as well. But Chris, there's obviously many other ways that we can get positive cash flow if you want to run through them.
Of course. So a lot of people, when looking for positive cash flow, are looking at units and townhouses. Obviously, the entry level is a lot lower, and often the cash flow on that rentability is really, really high.
Yeah.
So we, again, don't like sacrificing the fundamentals. If you're someone that's out there in the market for a unit and townhouse, making sure you're still buying in markets with low vacancy rates, making sure you're still buying in the desirable locations within a suburb, the desirable suburbs within a market, that sort of thing. We don't buy too many units and townhouses. It's not really our core strategy, as you've just discussed. We do really like that freestanding house and then the addition of the granny flat. But obviously there's some really good opportunity around Australia right now with how affordable units are in comparison to houses and how strong the rentals are because of such low vacancy rates Australia-wide. It is important to note, though, the combined capital city growth over the last 30 years has been 453% for houses, whereas the combined capital city growth for units has been 306%, so over that same 30-year period. So you're looking at a difference of just over 140% in combined capital growth between houses and units across the capital cities in Australia. This is really important to note, that whilst you are securing positive cash flow through a house, through a townhouse or a unit, sometimes or pretty much every time it means you're going to be sacrificing that capital growth like Simon touched on at the beginning of the video.
Yeah, over the long term. And it's quite similar with regional markets as well. Like, I look at that as a similar strategy. You can definitely buy lots of properties in regional markets that are generally going to be a little bit more positive cash flow for the same reason. It's a low entry price and the rents are still pretty solid in those regional markets. But as you said, the last 30 years, the combined capitals have increased 453%. Like, that is just huge. The top performing assets in the Australian property market have been houses in the combined capitals. Now, when you look at the combined regional markets and you look at the performance of houses over the last 30 years, they've gone up 313%. So once again, there's a huge disparity between the long-term capital growth of houses in capital cities versus houses in regional markets or units and townhouses in the capital cities. And I think this is important to talk about, because when we're going for positive cash flow, maybe in the current market, you're lucky to generate $100, maybe $200 per week. We're talking $5,000 to $10,000 positive cash flow per year. Now, I'd take it any day of the week. I want to increase my cash flow and make more money. Let's go. But that opportunity cost of lost capital growth is just too big for me to even justify. And I'm always going to look at that. Now, last year, we saw property investors, property owners generate significant capital growth in just a single year. If you had a $500,000 property that you bought at the end of 2020, by the beginning of 2022 in Brisbane, those properties had increased by over $150,000 worth of capital value.
Yeah.
You know, so $150,000 in a single year is substantially better than $5,000 to $10,000. So you've got to think a little bit more long term, and sometimes it can be worth it to justify a little bit of negative cash flow, say $50 to maybe $100 or $200 per week today, knowing that in the future you'll get positive cash flow from that property, but to ensure that you've got the quality asset that's going to outperform in the longer period of time. Now, there is some other unique strategies as well that you can implement to generate positive cash flow. These are things like developments. Definitely not our area of expertise, not really within our risk profile either. High risk, high reward type of things. Why don't you talk through some of the development opportunities?
Of course. So when we talk about development, we're talking bigger scope. So where you're knocking down to rebuild, like duplexes or a pack of townhouses type work, where maybe you can redevelop a site, sell one side to pay down debt on the other side, for example, if you're doing a duplex, and all of a sudden the debt position on the second side is really, really low, that the cash flow is completely positive. Same with if you do townhouses, for example, if you go and buy a property that has the potential for a 6-pack of townhouses and you sell off a handful of those, the remaining properties that you're keeping within that townhouse portfolio are going to be positively geared because of the low debt position. So it's all about developing to maybe on sell to then have low debt, because at the end of the day, your cash flow is going to be most positive when you're in a low debt position.
Yeah. And I've seen a lot of people do that and be very successful, just not a part of my risk profile. So it's not something that we'll personally do. The last one, you've got sort of commercial real estate as well. Commercial real estate, generally, you're going to get a really good yield, like 10, maybe 12 or higher percent. But you do have to deal with extended vacancy periods with commercial properties. It is a little bit riskier, in my personal opinion, but can be a really good way to generate really positive cash flow and also generate good long-term capital growth. So just like everything, guys, there is no silver bullet. There is no one size fits all. There is a lot of different ways that you can generate positive cash flow, but it does require making smart decisions or manufacturing that cash flow yourself. But there is definitely ways to do it. Now, if you're somebody that's sitting there and wanting to purchase a positive cash flow investment property, but not really too sure where to start, then we would love to offer you a free one-on-one strategy session. You can book that by going over to our website, www.pumpedonproperty.com, and following the free strategy session links to lock that in with either myself, Simon, my sister, Crystal, or our brother, Ben. During that, we'll talk about exactly where you're at right now, where you're looking to be in the future, both short, medium, and long term. We'll also talk about the current market and the areas in Australia where you can currently find positive cash flow properties. And then you can take that information, go and smash it yourself. Or if you're looking for more support to execute that strategy, then maybe you can become one of the small number of clients that we work with each month, where we help people purchase investment properties. But either way, we wish you all the best of luck and hope you can purchase an investment property that generates you positive cash flow whilst also generating amazing long-term capital growth.
That's a wrap. That's a wrap.
Have a spin. Yeah.
Oh, sweaty. So sweaty. Oh, that's good. Look at that. So nice, eh? Oh.